Pessimism sells, but optimism pays. And there's a lot of headlines out there. There's a lot of kind of negative media.
Hello, and welcome to Mornings with Joel, Commercial Real Estate Podcast, where we focus on rising stars and established players in commercial real estate and talk to them about how they are building legacies in today's marketplace. Hello, and welcome to the Mornings with Joel CRE Podcast. We're back for another very, very exciting episode, and you're going to love today's show. This is Jordan Jackson of JP Morgan. And boy, what's up, Jordan? How you doing, man? It's good to see you again.
I'm wonderful. Thanks for having me on, Joel.
Absolutely. And I will say one great thing is that right now it's not 7 degrees like it was the last time we were together.
The last few days, we got 70 degrees. I mean, this has been awesome. I hope this isn't a pump fake.
Yeah, exactly. A head fake to throw us off, right? Yeah, I know in my market, the cherry blossoms have been out and everything else. So it's something, but I'm glad it's a little bit warmer today, and always good to see you without all those extra clothes on like we had last time.
I even get to throw on like a lighter colored blazer or jacket, so that's how you know that the warm weather's here.
There you go. Linen for springtime. It looks good, man. It looks really, really good. So, all right, well, fantastic. So, Jordan, who are you, right? For our audience, tell our audience who you are, what you do, and a little bit on your background, how you got to such a affluent position, if you don't mind.
Sure. So I'm from New York, originally from the Queens, Long Island area, Elmont.
Okay.
Went to high school out of Holy Cross High School. Grew up playing sports and playing music. So I was always a brass instrument player. Grew up playing the first instrument was a trombone. Then I actually spent 2 years at Juilliard's pre-college division playing the tuba. Then I fell in love with jazz and moved over to the trumpet. I still have my horn downstairs. Unfortunately, I don't play as much as I'd like to. Outside of that, I went to the University of Virginia. I actually interestingly studied African American studies, so was a liberal arts major. Had a lot of internships though, so intern at a telecommunications company, and then intern JP Morgan within the asset management business, and that's ultimately what translated to the full-time offer starting with JP. I've been with JP Morgan now this will be my 11th year at the firm, so you could certainly kind of call me a lifer. Is the only place I've been since graduating in 2015. And I've had a couple roles within the firm, so bounced around a little bit, all within asset management. First started with institutional business, so working with the larger institutional consulting firms. So think of, the Aon Hewitts of the world, the Mercers of the world, and trying to position JP Morgan products and strategies across both public markets and private markets with these consultants that they can then go position those strategies with their end clients. And their end clients are everywhere from, Coca-Cola's pension fund to United Healthcare's or UVA's endowment, for an example. So really the whole full gambit of institutional investors. And that was great because that was my first initial step into the market, understanding kind of concepts of investing at the institutional level, how these boardrooms and CIOs and investment committees, how they think through different asset classes, risk profiles. So it was really great to kind of get a sense of that from an institutional level. Did that for about 3 years and then transitioned over to our market insights team. My desire was really, I wanted to start to come up with the sweet sauce, right? I wanted to start to come up with the intellectual capital that JP Morgan was putting out, really be a voice for the firm. And that required me to, fine tune my chops, so to speak. So becoming a research analyst, kind of rewinding the clock a little bit, staying in that sort of analyst role, living in Excel, living in financial modeling, economic modeling. Again, this is stuff that I didn't really get a lot of as a liberal arts major, right? African American studies at UVA. So helping to sharpen those skill sets. And then ultimately I moved up, continued to progress. And now I travel across the country, really across the world, talking to investors, both on the institutional side as well as on the retail side, about JP Morgan's views, how we're thinking about the world, how we're thinking about markets, and ultimately, what does this mean from an investment perspective? Where are we seeing opportunities? Where are we overweight? Where are we underweight? So it's been a fun ride. I've learned a lot, but the more you learn, the more you realize you don't know. So the job keeps you on my toes for sure.
Wow. Yeah, that's really good. And I will say that that's encouraging. One reason why we started the podcast is because we really wanted to inspire the next generation of youth to be able to stretch forward and to have those opportunities like you've had. And I didn't realize that it all started with an internship. That's just a beautiful thing. But it shows if you apply yourself, look at what can happen. And now you're sitting as the executive director for global market strategy. So that's very, very impressive, man. So congrats on that. That's huge. I would
Thank you
think you
so
spend a
much.
lot of time with your suitcase, man. With that position.
Look, it is a lot of travel. My wife gives me some pushback on it, but it does. It keeps me on my toes, and I'll do media appearances as well. So I'll often either be on Bloomberg or CNBC. And again, the markets are always shifting, always
Yeah.
changing. So you really
Yeah.
never know what you're going to get right when you go live and things like that. But it's exciting. It's a lot of fun.
Yeah, yeah. I know when I was a contributor to CNBC, I could be out doing anything and get that phone call like, "Can you be on the air in in 15 minutes?" And I'm like, "Yeah, I gotta go where? What studio?" It's like crazy. So they
Yep.
still doing that to you? Same thing?
Yeah, yeah.
Yeah,
It won't be
always
it
last
won't be
minute, right?
15 it won't be 15 minutes, thank God. But sometimes they'll be the day before or a couple of days before. Hey, want to get your thoughts on, what's going on in the Middle East or what's
Yeah.
going on with software and private credit. So you kind of got to be dangerous in a lot of different areas.
Yeah, yeah, and I can see where that's the challenge. So, but we're a real estate podcast, so obviously we're going to focus a little bit heavier on that today, and dive into that. So let's kind of get to the meat and potatoes. I appreciate the background and all the good information that you share, but we're looking right now at the Fed that's kind of giving some patience on rate cuts at least in the interim, and CRE investors that kind of desperate for relief from what's going on in the marketplace. And I'm trying to get a view from you as we look at 2026. Is the rate staying higher a real catalyst that will unlock deal flow, or do you think we really need those rates to drop in order to unlock deal flow? Because it seems like the markets right now, at least in my opinion, are just kind of like, what do we do? Is
Mhm.
things going to get worse because of this war? Are they going to get better? I mean, it's like, what do we do? And obviously consumer sentiment always plays into that decision making as well. So, what's your thoughts on that?
Yeah, so it's been a big shift, right? And I think, coming into the year, we were starting to hear deal flow beginning to pick up. This was on the back of the Fed potentially cutting rates, continue to cut rates this year. They're expected to cut rates 2 to 3 times. That would equate to anywhere between, bringing that Fed funds rate down by 50 to 100 basis points or so. And since the conflict has played out, a lot of that has shifted quite
Mm,
dramatically. And so now the Fed isn't expected to cut rates at all this year. So I think, and you've seen this being reflected in things like the 30-year mortgage rate, for an example. We're now back above 6.5%, and that's impacting overall deal flow and mortgage originations, et cetera, et cetera. So I think the commercial market is a little bit different. Obviously, it's of course still very rate sensitive, but if you got to think about the starting point, and where we're coming from, and we're coming from a period in which the Fed was at 5%, above
mm,
5%, so that was certainly kind of impacting overall deal flow. They've come down, and what I always try to when we have these conversations with clients, they always try to paint commercial real estate with one broad brushstroke. Very, very different kind of underlying dynamics, underlying fundamentals, whether it be office, whether it be retail, apartment, or industrial. So for example, industrial, that's been an area of the market that's been, very, very tight given the broader data center, AI
mm,
build out, vacancy rates are below 5%. And so that's been a great place to be. When you think about a net operating income growth, that's
mm,
been tracking about 5% in the industrial space over the last year. Again, office is still one of those areas that's been a little bit challenged, right? We're seeing vacancy rates in office of about 14.5%. Net operating income year on year is down by about 5.5% in the office space. So that's still an area that's a little bit challenged. Retail, it's still kind of those lower quality type of retail strip malls, if you will, that
mm.
are kind of staying under pressure. But the nicer, more built up ones are doing okay, right? You're still
Yeah,
looking at in that market operating growth of about 3% over the last year. So again, there's pockets. We don't want to again paint this with one broad brushstroke. And what's interesting on the multifamily side arguably we had a period of overbuilding, right, over
Mhm.
the last couple of years. I would say it's sort of tailed off over the last 12 months, but certainly in 2022 and 2023, we were a lot of building. I think
Yeah.
everyone would acknowledge that there are a lot of cranes in the sky, but just apartment buildings just going up. So that market is seeing a little bit of cooling as of late as well. Again, unfortunately, tying this back to the rate story, I don't think you're going to get a big reprieve on rates, just kind of
Mhm.
given that the Fed is sort of focused on inflation and
Mhm.
where price pressures could go. So that limits how much they're able to kind of cut rates here.
Gotcha, gotcha. Yeah, that's a good point. I asked that because, and you mentioned about multifamily. I want to circle back to that for a minute. When you look at it, what we're finding in the market is that there's a lot of people who purchased assets kind of, with the lower interest rates that were out there, and now it's time for them to recap those deals. And the properties on debt servicing. You
Hmm.
can raise rents just so high in order to get that debt service to where it needs to be. And now they're under pressure to either, sell those properties at a loss or something else. So, that on one side it creates opportunity, on the other side, it might stagnate the market, especially as it relates to development, because everybody's going to look at, well, I could buy distressed assets. Why would I build? Are you kind of seeing that same thing in the marketplace on your side with your global perspective?
Yeah, no, we are. I mean, it's a challenge. Again, to your point, that the big rate
Mhm.
reset, the re-underwriting that kind of needs to happen in the market right now. Specifically for office, when you look at LTVs, loan to value ratios in the office space, they had peaked out just over 65%, which is quite high. They've come back down a little bit across, apartment and industrial, or I would say apartment and retail, default, loan LTVs somewhere between 40 to 50%. And actually industrial LTVs are quite low. They're actually in kind of the 30 to 35% range. So again, not painting the market with one broad brushstroke, but clearly leverage is a little bit more of an issue across office than kind of stacking it
Mhm.
across multifamilies and retail. So, that being said, if you've got capital, right, and you can pick up assets at a discount, I think none of these markets are going away.
Mhm.
They're just shifting. The dynamics of these markets are just shifting. So, as we see in multifamily space, tenants are looking for more amenities, nicer
Mhm.
amenities. They want more out of what they're paying per
Sure.
per square footage. In the retail space, a lot of sort of it's shifting away from kind of the traditional brick and mortar. We need foot traffic coming through the doors.
Mhm.
Many are shifting into more as kind of like a marketing piece. Like you've got to have your name out there. You've got to have the sign where people can walk by and see. And even if they maybe not walking in and shop, they may be reminded, hey, I need to go pick up a quarter zip, or I need to go pick up some new shirts. Let me go
Yeah.
online and in order, or maybe let me just go into the store and try out my size, and then go order online. So again, a lot of these markets are just kind of shifting. But again, if you got the capital and you're able to put some money to work on the equity side, things look pretty attractive.
Yeah, yeah, very good point. And I would think on retail, nothing has really changed from, a few years back, we were talking about the Amazon effect, right? Where all these, storefronts actually got obliterated. And the shift went obviously to things that you can't do online, right? You can't get a haircut online, right? You can't. And then even with groceries, I find that people prefer to not have somebody pick out their bacon and just send it to the house, right? They want to actually
Hmm.
go to the store and look at the fat content and everything else. So are you pretty much seeing the same thing from that standpoint, where or has the Amazon effect kind of phased out, or is it still pretty impactful and people are still more so shopping online, except for things that they personally want to get and things that have to be done in person?
Yeah, yeah. So I think actually, my personal opinion, I think there's a market for both.
Okay.
I'd say there are times when so I don't want to go to the grocery store, and so I'll
Yeah.
just hop on Instacart and and
Yeah.
but right, that'll be for when maybe I just need to get a couple items for the week, right? You get maybe some
Mhm.
milk, some orange juice, some butter, that sort of thing.
Yeah.
But standard stuff. But
Yeah.
we all have that, beginning of the month, or your quarterly shopping. You go to Costco
Hmm.
and you stack up. It's going to
Yeah.
be a big bill, but you stack up. You get everything kind of that you need, and the stuff that's gonna last you a little bit. So I think Yeah, I think there's scope for both of those markets, and I don't necessarily think one has to crowd out the other. I think there's still, when I go to shopping malls, whether it be in DC, going to Tyson's, or I'm now up here in New York in Westchester County, or just at Westchester Mall, it's packed. So what
Mm,
this it's folks just kind of going out and maybe doing some window shopping, or but whatever it is, these malls are pretty packed. So I think, again, the kind of the buying patterns are shifting in a way, but it kind of gets back to the earlier point that there's still, these are still integral parts of the culture and in our communities. And I don't think malls are going away anytime soon, and I certainly don't think retail is dead. I think it's just shifting.
okay, okay. It's very interesting. I won't dive into it a lot because it wasn't actually even my plan for the discussion today. But that's interesting what you bring about with malls. And it's where is the growth in the mall market? Is it mid-tier, or is it B and C or C and D malls, or is it which is almost like a flea market level, or is it the high-end luxury? I mean, where is the market as it relates to malls these days?
Well, I think it's malls, retail still being able to provide experiences.
Okay,
So where I see a lot of that foot traffic, really kind of the upper tier, more luxury, sort of malls that maybe have a movie theater attached to it, malls that
okay.
maybe have a hotel, that's attached to it. You got to make sure that you got Santa there, doing
Mhm.
pictures during Christmas
Yeah.
time, and you got the Easter bunny, for Easter Sunday coming up,
Uh-huh.
right? So, kind of these experiences, I think, are what's helping to attract people to the mall. So it's more than just going out and maybe feeling the pressure of shopping or having to
Mm,
buy something, but going to an area where you can have experiences, you can be social. A nicer food courts are always a plus. An
mhm.
area where they've got a space carved out where kids can go play, and that sort of thing. All those things are what help to generate that foot traffic, and it's ultimately on sort of those upper end, more luxury type facilities.
Gotcha, gotcha. So you still see that the lower end malls are still going to struggle a little bit. I mean, I see that, but is that what you're seeing also, kind of the lower end are just really not getting the traction, or they're just filling up with nail shops and you know hair weave places. I mean, is that what we're
Yeah.
seeing?
Again, I grew up, like I mentioned, I grew up kind of in, the Long Island, Queens area.
Yeah, yeah,
So, I used to go to Jamaica, right, to
yeah.
get
I know
home.
it. I know it well. Yeah.
So, you think about kind of that sort of strip, if you will, as
Mhm,
as one example. There's still those collections, some of those mom and pop shops, and maybe you just have committed shoppers that are there. But I was just there a couple of weeks ago, and I just wasn't seeing the same kind of traffic that I'd normally see,
yeah,
outside of just, folks going to and from work, getting off the bus, and doing the, transfer
yeah.
thing. But I just didn't see a lot of folks kind of just out there, shopping, right? So very different story when I go to, like I mentioned, the Westchester Mall up here in,
Mhm,
in White Plains,
mhm,
or Tyson's Galleria, or even Pentagon City, still
mhm.
seeing a lot of foot traffic there. So it's
Okay.
definitely, I think, kind of catered towards more of the mid to upstream, upper income area malls.
Okay, okay. That makes sense. Yeah, I know even in Atlanta, I had breakfast at Phipps Plaza. I guess that was last week. And, restaurant was packed. The mall had a lot of people in it. And this was early in the morning, like I said, breakfast time. So I see what you're saying. And obviously that's the premier, luxury mall in that market. So interesting. Let's do this. We're a couple of minutes behind, but let's take a quick break for one of our sponsors and we'll be right back. And we're going to focus a little bit on office. I want to touch on that briefly. But we're here with the Mornings with Joel CRE Podcast with Jordan Jackson. We'll be right back.
How do you build a company that lasts? One with a solid foundation that gets better with time, transforming the first dollar in your bank account into something more, building a product, a team, a culture, expanding to new countries, currencies, and customers, and accessing the capital you need to grow. How do you do all of that? with powerfully smooth banking that keeps you focused on bringing your vision to life.
Step into the future with EcoCrypt, a platform unifying decentralized finance with real-world utility, where value flows freely. From gaming achievements to real-world assets, everything can be tokenized, fractional, and accessible in one trusted ecosystem. For gamers, investors, and global communities, EcoCrypt is breaking down barriers and democratizing finance. Join the revolution. Visit EcoCryptUSA.com today.
Good mornings with Joel CRE Podcast. We're here with Jordan Jackson, global strategist for JP Morgan Chase. So Jordan, again, thanks for being here today. I wanted to ask you something a little bit related to JP Morgan's own research about office completions. It seems like they're set to fall, according to your data, about 75% in 2026. But it seems like to be also a flight to quality, which is actually driving out rent in upper tier properties in Class A office. So is the market kind of splitting in two, where you have, this upper class A office building that actually is increasing in value, and is B and C just going to get crushed out of existence, or get torn down and made into multifamily? I mean, what do you see really happening there?
Yeah, it's a great question. Really, really interesting kind of dynamics that we're seeing. And I gotta be honest, I'm a little bit biased. So I work in the brand new 270 Park building, JP Morgan headquarters, 60 floors, 30
You got to
foot
take me
floor
on
to
a tour one day, by the way, because that's a beautiful building.
I got you. But 30 foot floor to ceiling windows, gym on the 24th floor. We've got, I want to say, 11 restaurants and a bar in there that you can't even get a
Wow.
seat. So
Really?
you really feel like
man.
you don't have to go anywhere from
Wow.
8 to 5 or 9 to 5, whatever you work. But I've got a good buddy of mine who works at Cushman and Wakefield, and he really focuses in on the office space and with the larger tenants, specifically in the New York City market. And one of the things that we spend a lot of time talking about is he's very excited. He feels that office is back, right,
Really?
in New York. And what's been interesting, when you actually look at sort of U.S. office net absorption,
Mhm.
it's actually been positive over the last couple of quarters, after several quarters of being deeply negative
Really?
over the course of 2023 and 2024.
Mhm.
So again, I think we're starting to see that revival. And what's also noticeable when you think about absorption by building vintage. So for those properties that have been built from 2015 to present, you've actually seen net positive absorption in those markets,
Mhm.
meaning that demand is essentially outweighing the supply coming online. What we've also seen, and I spend a lot of time, institutional offices, a lot of time at advisors' offices, whether it be, the Edward Joneses of the world, the Ameriprizes of the world, and what they're doing, and what we're seeing a lot really across the country is redevelopment. So taking kind of an existing building, sprucing it up, giving it a new vibe, change the lighting, put some
Mhm.
more some windows and make it feel more of an open space. A lot of offices are creating more office open spaces and moving away kind of from the traditional sort of cube style that we're all, fairly familiar
Sure.
with. And so, I think, I think office is back. And, I think, even just kind of the banter amongst CEOs in terms of, I think depending on the industry, hybrid work can work, but I still think in those city centers, those hubs, particularly finance, consulting type of jobs, there's a desire to get back into the office. There's a desire to shake hands. There's a desire to get, deals done and to network. And I think, and this is kind of me as I, kind of put my economist kind of longer term hat on, in an environment in which, we're looking at how AI is impacting overall job creation. And we may not necessarily are seeing it translate to layoffs in the economy, but we are seeing this translate into higher levels of youth unemployment, higher levels of even MBA graduates seeking employment.
Mhm.
I just did a session with Harvard Business School alumni, and you wouldn't believe 2024 Harvard Business School MBA grads, 2025, excuse me, last year's round of MBA graduates from Harvard are still sitting at 30% unemployment rate. I mean, this is remarkable, right?
Wow.
So, what's the option? Well, the option is, maybe you can get on your computer and, build a business or an application and try to sell it, or you go into an office, you
Yeah.
shake some hands, you network,
Yeah.
right? And I think, this is part of what's going to hopefully help to allow for, more demand for office space. We're seeing the demand come on, and I think it's going to continue.
Wow, that's a very, very interesting perspective on that. And I asked that because, or I mentioned that, I look at the tech sector because you see that they're talking about massive layoffs, for an example. And a lot of those folks, well, I guess in tech, they're at home and in the office, but because of the way those offices have been designed in Silicon Valley, you generally have people who want to come into the office because they're so nice. So I guess I find that interesting because if you're right. People do want to get back in the office. The human aspect of it makes people want to touch and feel and shake hands like we did many years ago. But I was kind of curious as to whether that was because I grew up in Manhattan. So
Hmm.
obviously, New York is always going to have a component of office. There's no doubt about it. That ain't going nowhere. But are you seeing that in secondary and tertiary cities as well, where you think office is back? Or is this just New York, Chicago, LA, places like that? Where it looks like office is back.
Yeah, I think it's the realization that, on those some of
DC
those
also.
those secondary, tertiary cities, I think it's one of those dynamics where companies recognize that they need the office space.
Mm-hmm.
They're still doing some of that kind of redeveloping of the spaces. But I'll travel on a Monday, right? And it's difficult to see folks on a Monday. You kind of have to do that Tuesday to Thursday kind of thing. That's where
Yeah.
you're going to get most of the people that are going to be in these offices and some of these, secondary and
Mm-hmm.
tertiary markets. And when I say that, I mean I may travel to Philly, but I'll go a little bit, 45 minutes out, out further west. And so some market or a market like Pittsburgh, for an example, these are those kind of cities where, I'm noticing that type of dynamic. And it's interesting. We've got data that would suggest that 40%, this is across the US, 40% of assets have almost no vacant space.
Mm,
Which is
really?
quite remarkable. So, I do think that, there's still that need for the office. Maybe some nicer spaces are still in demand, but in the more those smaller markets, I think, the office is accommodating, right, for that kind of hybrid schedule. But very few people, I think, are working fully remote. I think that number has probably come down consistently over the last few quarters.
Yeah, I would probably agree with that. I had a meeting the other day with actually last week with NASDAQ.
Mm,
And yeah, it was the same thing. They were saying what you were saying, that they work basically Tuesday to Thursday in a lot of cases. And so they have those extended weekends, but they're working from home. So it's an interesting
yeah.
model. Wow. So where's the opportunity? Is it in buying luxury office or is it in buying BC office and converting it and doing the upgrades and things like you were talking about? What are your thoughts on that?
Yeah, I think it's the BC, right? Because when we look at pricing per square footage,
Mhm.
particularly in some of these, higher end markets, we're we're back to really where we were prior to the pandemic. Now, again, it's been a long way, right? We're talking about 5 years of recovery time, but we're pretty much back to where we were. So I think the opportunity is in some of these secondary and tertiary markets and in sort of the B2C space, I would say.
Wow. Okay. Okay. Very, very interesting. That's good to know. You never know where the bottom is, right? And it's like, well, it was the same thing with retail, right? When COVID broke out, was it? No, it wasn't COVID. COVID hurt office. It was mainly the recession that impacted retail. Where
Hmm.
everybody went to shopping online. So interesting dynamic because you always try to figure out where that bottom is, but you've obviously done the research, and that's quite interesting. So I appreciate that. Let me pivot a little bit to tariffs and construction materials, immigration enforcement. That's been squeezing the labor pool. It's impacted projects that I personally have where, guys that no longer show up to work and I find out they're in hiding or they've left the country. It's a situation where you're saying, how is that actually going to help things? So it looks like we're heading into a supply crunch, which would help landlords, but are we going to be oversupplied? I mean, what do you think? What classes do you think are really going to benefit the most from the tariffs and the immigration issue that we're dealing with in the country?
Yeah. So, I would say more broadly, both dynamics actually are posing us pretty significant headwind to construction and overall building activity. arguably across the board.
Okay.
Let's first talk through, the tariff piece of this. So, we obviously have much higher tariff rates than we did back in 2023 and 24 before the administration came into place. Obviously the IEEPA tariffs were struck down by the Supreme Court, and then an initial blanket tariff was put into place. So to put some numbers around this, the average tariff rate before the Supreme Court ruling was right around 15.5%. That was our estimate. The average tariff rate now with the blanket 10% tariff, also with still some of the Section 301 and material and country specific tariffs, that average tariff rate by our estimates right around 12%. And there is talk about actually moving that 10% blanket tariff up to 15%, which again would be more material. So said another way, when we look at things like producer price costs, input costs, all those have moved a lot higher. This is not just the tariff story anymore. This is the conflict in the Middle East, posing challenges for oil flow, liquid
Hmm.
natural gas, impacting everything, the jet fuel prices, electricity prices, even agriculture. You think about, the fact that a lot of urea, which is a key input to fertilizer,
Hmm.
flows through that strait as well. And so,
Hmm.
when you look at broader agriculture prices, things like corn, wheat, soybeans, the agriculture, broadly are up about 5% over the last month as a result of some of the conflict. And again, this has cascading implications for costs across builders, right?
Hmm.
Across lumber prices, across aluminum, across steel, across copper. So all that is impacting the actual input costs.
Right.
Now you're talking about labor. And to put some numbers around this, in 2024, net immigration was about 2.7 million into the United States. In 2025, that number was cut in half, down to 1.3 million in 2025. And the Census Bureau now estimate that this year net immigration is essentially going to be flat. So when you think about the impact, right, in terms of labor and being able to find that electrician, that plumber, that some bricklayer, that cement layer, it's really challenging. It's
Yeah.
really challenging out there. And I think that is one of the reasons, a myriad of other reasons, particularly in things like residential. One of the reasons why multifamily construction has come down. It's just because, again, just the cost, the input costs of the
Yeah.
materials themselves, and then finding the laborers to actually get the job done. Because as you know commercial
Yeah.
real estate better than I am. A lot of times we'll run the numbers, we'll run the KGERs, we'll run the IRRs, but the most important thing is to get the job done.
Yeah.
Trusting your counterpart to be able to get, right, to get that building and
Mhm.
facility up and running. That's why
Right.
and on
Yeah.
time, which
Yeah.
very rarely happens, and within budget.
Yeah.
So, and that comes down to, like we talked earlier, trust,
Mhm.
right?
Yeah.
Having that network of individuals. But I do think it is both these dynamics are significant headwind to construction activity going forward.
Yeah. Yeah. So the question I have to ask because of that situation is where's the opportunity? Or is there an opportunity? I mean, is there anything that you see from that standpoint where you say, okay, probably because of this, we won't have a whole lot of new inventory going online. Like you said earlier, multifamily technically was oversupplied in certain markets. So where do you think that opportunity sits right now, since there's probably going to be a lull in activity of properties coming online?
I got to be honest. It's a bit difficult. It's a bit difficult to identify.
Okay.
A severely discounted, market where you can get, new builds or add-ons, maybe something more like, add-ons are something that starts to look a little bit more interesting, or bolt-ons, whether it be, trying to increase the market value of an existing
Mhm.
property,
Right.
by, adding in a pool or putting on a rooftop on a multifamily, or something like that,
Sure.
where you can create, some more additional, value, reset your cost basis in that regards. And so that's perhaps maybe something that's more palatable
Mhm.
versus, completely starting from scratch with just bare land.
Yeah. 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 Good point. Good point. Any idea? Well, no, you wouldn't know that. I was going to say any idea as to how long this whole thing might go on to things stabilize, but that's impossible to know because
Well,
like
I'd
for
say this.
example, we hear that there's going to be no ground troops, but paratroopers are being sent over. I mean, I'm not getting into a political discussion. Understand that, but it's just, there's no way of really saying when this is going to unravel and things will kind of stabilize because it's just too many unknown variables. Is that safe to say?
Yeah, so we kind of have this framework as we've been talking about this conflict, and for us, it boils down to the three M's: munitions, markets, and midterms.
Mhm.
So when you think about munitions, U.S. we have a lot of money that we can throw at the problem, but we don't have an infinite amount of munitions, and
Sure.
particularly the sort of obviously the IRGC, the Iranian government, they've got a lot of drones that they've been sending and wreaking havoc in terms to a lot of energy infrastructure out of the region. We're using a lot of our interceptors to intercept those drones ultimately. However, those drones are a lot cheaper to make than those interceptors. So, that's a challenge in and of itself. And our
Especially
munitions
the
are actually
Houthi drones, right? I mean, those drones, they're
right.
building for like 14 grand or something, I heard. So I don't know.
Yeah, and like, an interceptor could run, a couple million, right? And so that the economics of that are become a lot more challenging. And then it's also pulling away, aid that we're sending to, Russia, Ukraine, right? Ukraine on that front. So it is becoming a binding constraint, so to speak. And then of course you've got markets. So the second end markets. I would say that's all the things from, risk assets, equity markets. We know the administration likes rising equity prices and risk assets, but also the impact that this is happening on markets like oil and the price of gas.
Yeah.
Gasoline, the average retail gasoline price right now is above $4. So we've gone, pretty much in a month span, full dollar increase in,
Yes.
in a gallon of gas. And you can't drive 2 city blocks across America without knowing what the gallon of gas is to two decimal places,
Yeah.
right? That is the clearest form of inflation across consumers across
Absolutely.
America.
Yeah.
So it's very clear. It's front and center. And then the last one being midterms, right? Support for this war is very tenuous.
Mhm.
And I would say that I would even go as far to say, even when you look at the approval ratings have come down. Estimates have been shifting in terms of the outcome of the midterm election. So there was about a pretty high probability that the Republicans were going to stay control of a slight majority, about 50% probability that the Republicans were going to keep control of the House, stronger probability that they were going to keep control of the Senate, just the way the numbers worked out. Well, now I'm looking at, Poly Market, Kalshi, some of these other betting markets, 85% probability that the Republicans lose the House, and now a slightly greater than 50% probability that they lose the Senate. So we could be walking into a period of divided government. Now, again, if the administrations wants to maintain that majority across all three houses of government, you know, politically, they're going to pull out. You got to pull out. You got to end this thing as quickly as you possibly can.
Yeah.
And so, we've heard yesterday perhaps a bit of an off ramp where they're willing to take a step back, basically end the war, even if the strait doesn't open up. That yeah, I'm not really sure that helps anybody because you're still looking at higher oil prices. You just don't have announcements of vets, U.S. vets, unfortunately being killed or injured. But in short, I would say politically, it would be most advantageous to wrap this up as quickly as possible.
Mhm.
I just think there was a big miscalculation here. I think the president thought this was Venezuela, and this is a very, very different, a very, very different
Different
counterparty.
animal, man.
Yeah, yeah,
Yeah, those Persians have been fighting for a long time. So
they're used to it.
they're used to it. Yeah, man.
So,
Long time before America was even here. So
hmm hmm
anyway, all right, let's do this. Let's take a quick sponsor break and we'll be back.
The Impact Air 99. We asked real people, try the Impact Air 99.
Breathable, light, but protective.
Feels very comfortable wearing it. It looks cooler.
It's almost surprising how much air you can get in.
Engineered with 6 layers of nanoscreen technology that blocks over 99% of viruses and bacteria while allowing you to breathe freely and speak clearly.
My glasses are not fogging up.
I could wear this all day.
Sage Data is your automated recruiting hub for any size organization. The concept is simple. If you have lists of prior applicants, Sage Data will clean, update, and convert those lists into digital resume profiles that are searchable. You can also post unlimited jobs in the system, and our AI will automatically search the database and bring back potential candidates for you. Head over to sagedata.io.
Here on the Mornings with Joel CRE Podcast, again, we're joined by Jordan Jackson, Global Strategist for JP Morgan Chase. So thank you again, Jordan, for being here today. Exciting conversation with all that's going on in the world. And, you know, it's always like you're trying to figure out where to go, but the windows on your car are dirty. And it's nighttime, right? And you're like, is that what I see? No, maybe, you know, it's like you're trying to figure this thing out. So it's kind of crazy. Let me jump into multifamily right quick. You know, it's often described as something that's structurally supported, meaning that the structure of the United States economy supports multifamily housing because we know, you know, and it takes 10% either way, whether it's ownership or multifamily. That kind of pivots both ways. But right now, statistically, there's 22 million renter households that are severely what we would call cost burdened. And obviously the price of gas and other things are not making it any easier. So is the affordable housing crisis, in your opinion, to become a symptomatic risk, or seismic risk, I should say, to the overall broader multifamily thesis, or is this an opportunity hiding in plain sight? You know, in other words, is the affordable housing crisis going to crush the market and certain aspects of it eventually because prices are just going to go higher and higher and homelessness will increase, or people will start moving back to CD properties? Or is this a huge opportunity, you know, that's in the marketplace that we can afford affordable housing if we can provide it?
You know, I'd argue that it is a huge, you know, opportunity. I'm seeing numbers where we still at a severe long-term deficit of about 7 million homes, you know, across the United States. So that is a real challenge. And, you know, also kind of, again, putting on a very more macro level hat, the broader increase in overall income inequality, you know, suggests that, again, we've already have this severe deficit in terms of inventory and overall supply. And then assuming that, the next recession, we get another spike higher in unemployment. You also have this displacement happening across labor, which could have an outsized impact on sort of lower income, individuals, potentially increasing the overall demand for affordable housing. And so, I think I think it's a real opportunity. I would say if you can get into the space. Now, I've got a very kind of personal example that I can share with you. And so I mentioned that we moved from DC. My wife and I, we moved in 2021. We bought our first home in DC. It's a new construction, was built in 2020. We bought it and moved in 2021. Again, kept it real nice. But again, we moved in at a 2.5% interest rate. So why would I sell that property? So we maintained ownership. And when we moved back to New York, the intention was for obviously to get single family renters, a tenant in there. Did the process of getting my basic business license, did the process, registering my LLC, property management company, all this sort of stuff, and then put it on the market. Was working with an agent in the DC market. And so it was a tough time. We moved in October, right? So that seasonality was a little bit of a challenge, but we ultimately started to move forward with DC Housing, so their voucher program.
Okay.
And I will tell you, it has been a huge headache working with DC Housing and the application process. I actually found a tenant, which I would love for her to move in, but this has now been a 4-month process just getting a tenant and the paperwork. She's got all her paperwork. I've got all my paperwork. I's are dotted, T's are crossed. Yet it takes 7 to 15 business days, right, just to get a response in sending some initial paperwork over. So it's I'd say the regulatory challenge is a real issue at the local level, and I recognize, again, certain markets are different, but it's clear DC specifically is understaffed. And I talked to the DC rep, their agents, and they're saying that sometimes it could take up to 6 months to get a family placed into a home.
That's
And
insane.
that's insane,
Yeah,
insane,
yeah.
right?
It's
So
crazy.
like while clearly we need, and I'm happy to do more and bring more properties online and things of
Mhm.
that nature. But if this is going to be the type of hurdle that's a real challenge, kind of getting into the market.
Yeah, yeah, big time, big time. So what's the lesson we learned from that? Maybe well they've got to get their act together. And like you said, every market's a little bit different. We
Yeah,
know that sometimes the larger northern cities have problems, but do you think that this is going to lead to a situation where people are just going to really start migrating to the Sun Belt because real estate's cheaper, affordability with housing and everything else is cheaper, and those markets tend to move a little bit faster when it comes to getting things done, just because
absolutely.
they don't have all the infrastructure, that
Yeah.
they've got to deal with. Yeah.
Yeah, no, 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 absolutely. I strongly agree with that. I think it is, we're seeing that in a lot of the migration patterns already.
Hmm.
Folks moving out of moving out of the Pac Northwest, moving out of the Northeast, moving down to the southern states, the Southeast, the Sun Belt parts of the country. Even to enough extent that it's even outpricing locals in the Sun Belt of purchasing and owning
Yeah.
real estate in their own
Yeah.
markets that they
Yeah.
grew up in, because as these migrations folks are moving in, that's moving up rents and that's moving up the price of homes in those areas.
Very true.
So I think you are going to start you're already seeing a lot of that kind of motion in the markets. I think to a certain extent, while again multifamily has kind of come down, when you just look at the spread of the cost of owning versus renting, I mean, it's just been a gap wide higher, where owning has become a lot more costly and a lot more expensive because of the price of homes, because of mortgage rates, where in many markets it's still more advantageous to just rent. And so if you're able to kind of come in, get a duplex, get a four-door type of situation, and adjust it, allow it to be
Mhm.
affordable housing. The benefits of affordable housing, you've got very little tenant risk, right? Because you're getting a check getting cut, or at least part of that check getting
Yeah.
cut directly from the municipality or
Mhm.
the state government. So there's that confidence in cash flow dynamic that you have, and I think those markets that you mentioned, the Sun Belt, look pretty attractive.
Yeah, yeah. It is a very interesting dynamic because you have a lot of relocation because of that. But then, as you mentioned, $1 million home in New York or Los Angeles compared to a Dallas, Atlanta, Phoenix, it's totally different. It's totally different. And so the idea of a starter home for a lot of people in the South might be $300,000, 200,000, wherever you are in the South, but in the North it's a million, right? So the mindset is totally different as to what can be acquired. So it's very interesting. I'm wondering though, because we always want to look at opportunity in the marketplace, and you have the luxury market, you have the C and D market, which some of the affordable product is C and then you have the B that you try to move up to A. From that standpoint, where do you think that opportunity lies? Is it in, because we talked about issues with labor, so maybe
Mhm.
you don't want to get into new construction and redevelopment. You can't really build a brand new Class C building, right? You generally are going to build. There's always going to be a standard above that. So it would appear, and correct me if I'm wrong, that the opportunity might be in maybe C grade properties or maybe even D that can be upgraded, where you don't have all the development costs and risk associated with it, and you can manage your cash flow because you keep some units occupied while rehabbing others. Does that sound like that might be a feasible strategy in a situation like this?
Yeah, I think one of the key point that I would add is, and as is the market. The market matters, and dynamics, whether it be, hey, did Amazon just move in or set up an office, or did another big player kind of come in, or did they just put a Trader Joe's, kind of here? So I think all those types of dynamics, really matter in certain specific markets. We sort of talked about again, pricing is pretty much right back to where we were prior to the pandemic. So you're not
Yeah.
really getting a whole lot of value in the luxury, if you're on the development side. I think within kind of B and C, that's really where it's probably already in an existing market with high foot traffic, Good. Again, I want to cater a little bit more towards that Sun Belt region where you've got net positive migration. So folks are moving in, not folks
Right.
moving out.
Right.
And potentially there's some opportunities where you can start to build, develop add-ons and provide more experiences on some of these B2C properties in these markets where you've got net positive migration flows. And then I would also look at incomes in the area, right? You really want to be looking at markets in which you've seen consistent kind of steady income growth or wage growth within these municipalities. And you can kind of look across the Census Bureau, you can look across a number of Fed data sets, because you really want a market that arguably has incomes, growing faster than cost and inflation. And they can spend a little bit more on the home. They can spend a little bit more on rent. They've got that cushion to spend a little bit more, which is supportive as an asset owner
Right.
for cash flow projections.
Yeah. Oh, makes sense. Makes sense. So it's always trying to find that little vein. It's like a running back looking for the hole with with your tackles, trying to get through there so you can
Right.
get down the field. Just where's that little gap so you can make that move. Very interesting. Very interesting. And we just have to see how things play out. Because it's interesting. There are challenges, but let's be honest. If you've lived long enough, every single market has its headwinds, right? So it's just a matter of trying to navigate those and see, where to go.
And I would just say,
yeah.
this is really an important time for, the real estate market, because again, we're structurally in an environment where, we overbuilt leading into the GFC, we underbuilt for a decade, demand really, skyrocketed coming out of the pandemic. So we're still in a position where we're undersupplied inventory, whether it be I would even go as far as say multifamily, certainly within the single family market. And then given how low mortgage rates were, existing inventory remains very constrained. Not a lot of existing homes coming on the market. However, because of this immigration dynamic that we've talked about, flat net immigration potentially for 2026. We also have the baby boomers that are aging out, the Gen Xers that are, transitioning. At some point, right, the demand is either, and it seems that which could be in the right with demand, is going to catch up, isn't going to catch up with supply.
Yeah.
Because if you've got net negative population growth, that's less people buying and need for homes. If you've got an aging population, you've probably got more folks that actually own their home, have no desire to really kind of move, or comfortable kind of where they are. And so you got to worry that, at some point, and then maybe this is a 10-year story, right? Talking about next 10 years, you're gonna have enough supply ultimately to meet kind of the demand that's out there. So you want to be getting into a market now where demand continues to outstrip supply, and get that ownership, get those tenants, get that cash flow, and because I think it's going to be a very different dynamic in 5 to 10 years from now.
Yeah. You bring up a very good point, because like you said, if you have net zero migration into the country, and then at the same time you have an older population that's aging out, and that's a very large class of people, that we're talking about, then that demand drops down significantly, but that creates problems as well if you're an owner of real estate, because now there's tremendous inventory on the market. And you've got to keep dropping prices. So now you have deflation instead of inflation in the real estate market. So that could be a major problem, 10 years from now.
Yep.
So thinking about that, let's talk about that. Where in the market, and I'm talking about real estate specifically, do you think the market has it wrong, where maybe they're too bearish or too bullish right now? Any thoughts on that, as to where you might say, what, everybody's, like, for an example, and I'm not putting words in your mouth, so don't let me do that. But you mentioned about office, where most people would say, no. But you're saying, look at the data, right?
I think,
So,
I would say I think people are too bearish on office.
okay.
I think some of the opportunity, as we've talked about, the demographics, is in managed care facilities.
Okay.
That looks really, really interesting. Again, as you see, folks getting older, but also living longer,
Sure.
there's going to be more challenges in terms of, are they getting enough care? In many cases, given how the economy and prices are moving forward, you kind of need both. If they've got kids, it's likely that their kid, married, maybe have a family, but both of those folks are working, have to work, so they can't provide that kind of hands-on care.
Sure.
And so we're seeing a lot of demand for managed care facilities for elderly. And I actually did a presentation last year out in one in Sacramento. We're seeing not just the building itself, but full on communities, right, for these individuals. And that's, again, very very kind of stable, and you could ultimately have a tenant that's there for 20 to 30 years,
Yeah.
just given how long folks are living. Part of the challenge, though, is, again, it kind of gets back to labor. You need qualified caretakers and caregivers, and nowadays you got to pay them a lot of money as well. So that's something to go into it. But the nicer ones, some of the rents that you're charging for
Yeah.
these places,
Yeah.
it's material. It's quite substantial.
Yeah.
So I think there's opportunity there. I think those B2C offices in those
Mhm.
maybe some of those burgeoning markets where you've got net positive migration. You got companies like, I saw Aries, for an example. It's an alt shop who's looking for secondary headquarters, some down in the South. And so if you see businesses shifting,
Yeah.
we as property owners and investors should certainly be following suit. And then I think, look, industrial is going to do what industrial does. That's going to continue to be a market that I think is well supported, whether it be warehouses, whether it be data centers. I think those trends are not going to go away
Mhm.
anytime soon. And then also what I've started to see a little bit more of, particularly in the single family space, is, again, rather than doing a full on building from the ground up, take kind of an existing single family, and if you got space, attach an additional unit, right?
Yeah. An
And
ADU. Yeah.
an ADU, there you go. And that's been a way to kind of supplement and provide some additional cash flow as well. And I think that's an area where my father-in-law, he essentially did that, and found a great kind of
Mhm.
long-term tenant. They have their own space. They're very happy. And I think certain markets, again, where maybe they don't want to live in the high rise, but they
Mhm.
want something a little bit more comfortable and to themselves. I think that makes a lot of sense also.
Yeah. Yeah. No, that's interesting, and it's an opportunity in the marketplace. I was just thinking of one of my clients, right now. He did that with his personal residence, which
Mm,
is an area where they're doing more outdoor concerts and things like that.
mm,
But he built this ADU, and it's over a 3-car garage. And I mean, it's like, 1,800 square feet with a dog wash and everything else. I mean, it's a full blown place.
yeah.
Yeah, it's amazing. And, you could really sell it as a separate house just because of the way it's structured. So that's really interesting. So a lot of opportunities in the marketplace, and it's interesting just trying to, navigate what do you do today as opposed to tomorrow, where are we going to be at in the future. And I appreciate your comments about, what we might be looking at in 10 years if we have net zero immigration. I don't think that's something that a lot of people look at, but that could dramatically drop real estate values. So we need to be careful about that and see what the opportunity is. Maybe the opportunity is in, some of the younger generation class and providing housing for them, so that
Hmm.
and doing that now as they get stable, and maybe play the transition game from their first house to their second, or their first property to their second, as opposed to, some of the other areas. So I don't know, lot to cover there, a lot to unpack, but a lot of good information. And Jordan, you made it simple and clear, and we certainly appreciate it. It's been a beautiful discussion.
This was a lot of fun. This was a lot of fun. Really, really appreciate the time, Joel, and I hope the listeners enjoyed it.
Yeah, absolutely. Absolutely. Anything you want to conclude on as, representative of JP Morgan, or I don't even want to put that out there because then you're not representative. Well, you got the name right behind your head there. So I think you are. What would you
Um,
like to conclude on? I'll give you the last word.
Yeah, I would just say this is both from a public market investing perspective, real estate market investing
Mhm.
perspective. Pessimism sells, but optimism pays. And there's a lot of headlines out there. There's a lot of kind of negative media. because that's kind of what the news cycle, news flow really caters towards. But
Yeah.
if you've been an investor in the market over the last few years, whether it be public markets, if you've been an investor and picking up real estate assets at a discount over the last couple of years, if you took advantage of super low mortgage rates and interest rates in 2020 and 2021, you've done pretty darn good for yourself. Right. And so despite all of the headlines that are out there. So, I think it's one of those things where, capital is incredibly important. Access to capital is incredibly important. We're seeing evidence that credit availability is coming back online, gradually. Yes, you may not get the big rate reprieve, but arguably there may still be some scope for rates to come down. You've seen cap spreads move a little bit higher on the back of the treasury, yields moving higher as well. So again, there's still a number of opportunities out there. I think, you got to be very focused on the market, be very focused on the consumer base within those markets as you think about, the development, kind of walking through what we talked about, some of the opportunities. We think, office is back. The A stuff, the big cities, those are going to continue to do are actually pricing kind of where they were prior to the pandemic. But those B2Cs and perhaps some of those markets across the Sun Belt, the opportunity for some redevelopment, sound and look pretty interesting. Affordable housing, ADUs, all those continue to look interesting and flat interesting from my perspective. And I'll just emphasize the point on, I still think now is a good time to get into the market, right? As whether it be an asset owner, a developer, a flipper, right? I think this is still a good time to be in the market because again, I think we're looking at a very different structurally different market in another 10 years.
Yeah, very good point. And one thing I do have to ask you before you go, I would be remiss if I didn't. You mentioned about private credit loosening up and being more available. What about equity though? On that, do you see institutions and family offices and the other are loosening those purse strings a little bit because of the opportunities, or what are you seeing in your research?
Yeah, we are seeing that, and particularly given the broader quote unquote democratization of private equity and private credit, a number of vehicles are now allowing more retail capital to flow into the space. And again, you don't pay your private credit manager or your private equity manager to sit in 4% cash. You pay them to put money to work. So they pay to invest and get those deals done. So I think there's very much still that availability of capital. The big question mark is the access to capital. It's a nuanced difference between availability and access. I think capital is plenty of capital that's out there. One of the things that I appreciate that JP Morgan is doing is focusing on making that access to capital more particularly for minority communities.
Okay. And you know what? I can't end on that note because that is a major focus of mine as well, and in the organizations and clubs and other things that I'm part of. But that's a whole nother conversation, and we would go a whole nother hour if we dove into that. But I really want to have that. So what I'm going to do right now is invite you back. And, maybe, I got to see what the calendar looks like, maybe a couple of months or so. Let's have that discussion. What is JP Morgan doing to make capital accessible? Because that's 99% of the issue, especially for the majority of minority players. Statistically, they outperform a lot of the, I'm talking emerging managers here, outperform a lot of the bigger shops. But yet and still the bigger shops tend to get all the money over and over again. So, what is JP Morgan doing to help that? So that's a conversation. I'm not going to cheat our audience and just give a 5-second clip on. Let's go deep on that because I think that's a very, very interesting topic. So Jordan, I thank you for opening the door to that conversation, and we'll certainly make it happen. And look forward to getting with you because I definitely want to take that tour of that new building. It's funny. I was in, when was I? I don't know. I was in a hotel somewhere around 42nd not too long ago, and I'm looking out the window, and my window faced that building. That's all I could see was that building, and I was like, man, I got to get over there, man. It's beautiful. It's beautiful. It's just sticking up there in the sky, and at nighttime, it's gorgeous. So
yeah, and I don't want to gloat, but I am on the 42nd floor. My desk is on the 40th, so I got a pretty good view of Central Park.
All right, I'm hanging up on that note. Now you're rubbing it in, man. Now that's all good. That's all good, but very impressive stuff. So Jordan, I appreciate it. Sit tight for a second. We're going to go ahead and close out the show, and we certainly appreciate you being here. But for all of you in our audience, we thank you so much for being here and listening to our show today. Again, Jordan Jackson, Global Strategist for JP Morgan. It's been a fantastic discussion, and we certainly appreciate you being here with us. We look forward to seeing you next week as well. Have a great day.
Are you ready to level up in commercial real estate? Join us on Mornings with Joel CRE Podcast, where we bring you exclusive interviews with top deal makers, investors, and industry leaders. Sponsors reach a high-value audience of real estate professionals. Guests share your expertise and grow your influence. Don't miss out. Book your spot today.